Welcome back, traders and investors. I have on the show with me now Kate Stalter. She's the investment advisor at Portfolio Wealth Advisors and is a columnist for Forbes and Real Money. Kate, welcome to the show.
Hey, Garrett, thank you so much. Glad to be here today.
Yes, I'm glad you're on. And we might as well take this moment just at the top of the interview to announce to the Benzinga crew that Kate will be contributing mutual fund stories to Benzinga. And we're planning on having this relationship kick off in September. So, Kate, if we could just kind of focus on that maybe a little bit, what you're thinking about talking about, or what your views are on mutual funds as far as an important investment asset comparable to other options that are out there.
Yeah, absolutely. And I'm just super excited about this. I can't wait to get started, Garrett. One of the things, let's just kind of get to the elephant in the room, which is the fact that it's no secret that mutual funds have been losing ground to ETFs. And don't get me wrong, I'm not like advocating mutual funds. That's not. I'm not saying, well, you should have mutual funds rather than ETFs. That's not really the point. The point of what I want to do in these new columns that I'll be writing will be to really educate people about the pros and cons when it's appropriate, show people some specific funds that could be appropriate in certain situations. Really, we want to drill down and look at cost and performance. The fees, the expenses can really eat away at your returns. And that's something that if you're not careful about it, your money is not being invested and going back to work for you. It's going into some fund manager's pocket. Now, a lot of people, Garrett, they like to think, well, that's exactly the reason I don't want to invest in mutual funds because I want to save money and not have these fees and expenses so high. Remember, if you're trading single stocks with a brokerage, they're making a lot of money off of your trades. And in fact, they're encouraging you to trade. I mean, I go online all the time and social media. I see where the brokerages are out there kind of asking little questions to get people trading. So there's no free lunch is what I'm really trying to say. And again, I'm not advocating one approach over another necessarily, but I think it all has to be very, very carefully considered. You have to have an investment philosophy and understand you have all these different tools you can use to put together your portfolio. You have mutual funds, you have ETFs, you have stocks, you have bonds, you have options, and so forth. So it's really being very, very smart, deliberate, considering very carefully why you're using each one. And that's what I'm going to be talking about in these columns.
Excellent, excellent. Well, I'm looking forward to that because I do believe that the deliberate, conscious decision about what type of exposure you're willing to take on with this monetary tool is very critical to succeeding out here. Now, speaking to that and speaking to the process, let's touch on what you were talking about as far as core and satellite strategies. Now, how would you
Mm-hmm.
tie mutual funds into this? Is this something you would look at first if you're allocating resources to a portfolio, or would you want to look at mutual funds later and maybe pick specific stocks that you know? Well, what would your thesis be there?
Right. So think about what you're trying to accomplish. That would be the first thing I would say. And I am. Now, I said I'm not an advocate of, say, mutual funds versus ETFs versus stocks. I am an advocate, however, of long-term investing in at least a portion of your portfolio, okay, because I know a lot of the listeners are traders, and that's fine. But in at least a portion of your portfolio, make sure that you do have the long-term investment and you understand why you're investing. For most people, the reason they invest is for retirement. And, it's really fashionable today to say, I'm never going to retire. Well, that's nonsense because everybody reaches that age where you're like, oh, I just don't feel like going to a job anymore. And if I want to work, it's going to be for fun, not because I have to. So you want to be saving for that day. And in that case, then yes, you want a core portfolio that you're not betting on single stocks because that's what it would be. If you're saving for a particular objective, you don't want to be making bets on single stocks. You want index funds, and those can be ETFs or mutual funds, but you want to be investing, tracking indexes. Now, it's interesting because if you kind of start to drill down into what I mean by that, then you can look at, say, rolling 5-year returns for the S&P, for example. And there's data from a company called Ibbotson that is very clear that on any rolling 5-year period that you pick, the S&P 500 will beat any other index, any other major index. So that's pretty compelling. I'm not saying you only want your core then to be the S&P. You do want it allocated. You do want exposure to small caps because over time those tend to perform very well. You do want some bond exposure, okay? Not all bonds are equal, by the way, because if you're in high yield, trying to really juice out those returns, if you're in high yield, you might as well have stocks because that's very stock-like investment. You want to be careful of long bonds as well. You really want to be more tilted towards shorter-term bonds. Even though the returns probably a little bit less, you still reduce your risk significantly. So when I'm talking about your core part of your portfolio, you definitely want to be indexed into something that has well-established empirical research showing you the expected returns. Then on the outside of that, you can get into some more active management, either with some actively managed funds or, again, to address what probably most of the listeners are interested in. Yeah, at that point, you can start to put together a portfolio of some single stocks and start to look at how you can add some alpha from that perspective. So that's really, in a nutshell, what I would do, Garrett.
Okay, excellent. Well, thank you, Kate. Now, coming from your view with the core and strategic, and the clients that capital that you manage for, can you give me a breakdown of your average client, the exposure to bonds or stocks or ETFs, managed futures, fixed income? Is there kind of an overall theme that you've noticed with the people that you're involved with as far as advising them on what kind of portfolios they should be building? Is there mostly exposure to bonds or mostly exposure to stocks that you could tell us about?
Sure, absolutely. Again, this depends on your objectives. Depends on a few things. The traditional way this has been looked at as your age, and I'm sure you've heard this too. The old school of thought, which really is no longer used anymore, is subtract your age from 100, and that's the portion that you put in stocks, and the remainder you put in bonds. That doesn't really work so well anymore. You really need to look at your own situation on a case-by-case basis. Give you an example. Let me back up a second. Mm-hmm. We normally tend to put people in more aggressive, moderate, and conservative portfolios. Okay, so then you're just looking at a stock and bond allocation. Your traditional 60-40 stock and bond allocation. Say would be something that would be more on the moderate side. And that's where most of our clients are, quite frankly, because most of them tend to be either in retirement or maybe in their 60s, just approaching retirement, starting to think about it. That day when they no longer want to trudge off to the job anymore, because that day comes. So, when that's the majority of people, however, for example, let me give you an example of somebody I'm thinking of. He's about 70. He and his wife are about 70, and they have a tremendous income from pensions. He has just been very fortunate that he had a number of jobs that he was able to get good pensions. He doesn't have a whole lot invested, maybe about $400,000. And no, for retirement, that's not a whole lot. Really isn't, because not unusual for people to live into their 90s today. So he has about maybe $400,000. He's invested more aggressively because his objective is to leave a lot of this money to his children. So he doesn't have to be in your typical conservative portfolio you would normally recommend for a person in their 70s. So I think you see my point, Garrett, that it really is on a case-by-case basis.
Oh, okay, Kate. Yeah, it definitely is on a case. Are you still there? I'm not sure if I lost you or you just stopped after case by case.
No, I think I just ended there. It's really case by case.
No.
There's not kind of one size fits all answer that you would say should be the allocation. What I would say though, I will add something to that, is that again, I would caution against building a portfolio of single stocks as your core. And the reason I would caution against that is because, frankly, and this is research driven, this is not my opinion, the way average investors tend to do that is to kind of use something they saw on TV or they read in the internet, or, they got a tip from a neighbor. And that kind of thing tends historically, scientifically, to give you worse returns. And you know how everybody thinks they're a better driver than everybody else? You know that phenomenon?
Of course.
That's right. Yeah. We're all the best driver and everybody else out there is an idiot. Well, investing is kind of similar, is that everybody thinks they have the skill it takes to outperform the market. And usually in America, when people say the market, they mean the S&P. And that's a little bit of a misnomer, because when you say the market, you want to be looking at the global markets. That's a discussion for another day, probably. But the problem is when people try to allocate a portfolio centered around single stocks, in some time periods, it will do very well. 2013 and 2014, we have seen, at least up to this point, large cap U.S. allocated portfolios have done very well. Well, no kidding. The S&P 500 has had a fantastic run. No kidding. So in other time periods, though, you won't be that lucky, and that's when you're going to panic, start trading in and out, looking for some other tip, sell at the bottom, buy high because you're chasing performance. So you see what I mean? These are some of the risks if you try to use a single stock portfolio as your core.
Okay. All right. Well, thank you, Kate. I appreciate that. I guess we can wrap it up there. Again, this is Kate Stalter from Investment Advisors and Investment Advisor at Portfolio Wealth Advisors, and a columnist for Forbes and Real Money. And you guys will be able to find her contributions with mutual fund stories to Benzinga that are going to be beginning in September. So, Kate, welcome aboard, and we're going to be looking forward to having you publishing with us.
Oh, me too. Absolutely. I can't wait. Thanks so much, Garrett. This has been a lot of fun today.
Oh, yes. Thank you, Kate. I appreciate you making time this